banks have been actively covering silver shorts since July, likely continuing through November and December. U.S. banks appear largely, if not entirely, out of silver shorts, leaving foreign banks and other commercials with most of the remaining exposure potentially hedged via options or OTC markets. The OTC market is London. So you've got supply shocks from export restrictions. China now saying we're not going to export and we're going to hold it way back. And by the way, when the U.S. made silver critical, the president can completely shut off exports.
The shortage, the bear position, is actually in the foreign banks, or what they call non-US banks, which tells us that, these banks, what they tend to do, and we need to understand this a little bit, what they tend to do is to run long positions in London and short positions on COMEX. So in a sense, it's not too surprising to see that foreign banks are actually short on COMEX.
In this critical market update, precious metals experts Andy Schectman and Alasdair Macleod reveal a major shift quietly unfolding beneath the silver market, one that most investors are completely missing. They explain that U.S. banks have been aggressively covering silver short positions since July, with evidence suggesting they are now largely, if not entirely, out of shorts. That leaves foreign banks and other commercial players holding the bulk of the remaining bearish exposure. These non-U.S. banks, they note, often run long positions in London's OTC market while maintaining shorts on COMEX, masking the true level of supply stress. At the same time, global silver supply is tightening rapidly. China's export restrictions, combined with the growing possibility of U.S. executive action to halt silver exports altogether, are setting the stage for a powerful supply shock. This is happening just as paper short positions become increasingly vulnerable, with physical shortages emerging and risk shifting away from U.S. banks. As the imbalance between paper claims and real silver becomes harder to sustain, serious questions are being raised about price stability. The setup points to silver approaching a decisive and potentially volatile repricing phase. If you found this breakdown helpful, like, share, and subscribe to the Metal Hub. Turn on the notification bell so you don't miss future updates, and leave a comment below with your thoughts. Thanks for tuning in. Now, let's get into the interview.
Further problem we have is that China is no longer suppressing the price of silver. It has given up doing that. It's been suppressing the price of silver for a long time. China is the second largest nation by mine output. Not only that, but she imports masses of silver doré and also other metallic ores, where silver, if you like, is refined out from that. So silver, in terms of global supply, silver is by far the largest entity when you take both mine output and also refinery output into account. From January, it's been announced by the Chinese authorities that they're tightening up on licensing for exports of silver. And what basically the principle behind it is to stop excessive amounts of silver going out of China. They're not stopping it totally, but it will be restricted. Now, this comes at a time when demand for silver is going off the charts, not just photovoltaic cells, not just India, which incidentally has been subsidizing photovoltaic cell production. The demand for silver is going up very, very substantially. The reason that we've got this problem is that suddenly everybody in the industry, if you like, needs silver. They've got to go and buy it. So they're actually raiding the markets. They're going into London and buying forward contracts and standing for delivery. They've been doing this on COMEX more visibly. Stand for deliveries this year so far are about 15,000 tons. So COMEX is, we don't know the number in London quite so much, but COMEX is the largest silver mine in the world, effectively. It's the largest source of silver. So, by a long, long chalk. I mean, if you're looking, I worked it out, something like 58% of mine production is actually being stood for delivery on COMEX. This is just staggering. So it's not surprising that the price of silver is going through the roof. The COMEX margin requirements, I think, do make a lot of sense if they increase them in this environment. And I would expect them to continue to increase them. And yes, it does actually affect things because it's not just, the longs, if you like, but it's also the shorts. So you find that the shorts get squeezed. in this environment. I mean, the silver market is one where there is actually very, very low participation by speculators. Just look at the open interest. It's around about 150,000 contracts. I would say that the normal level is probably around about 170,000 contracts as an average over time, maybe a little lower than that. But this is not, a market which is driven by speculation at all. So when the margin requirements are increased, it doesn't hit the speculators so much, it hits the establishment. So, it hurts the bullion bank traders, the swaps, that category in particular. I think it's an interesting point that it's a further discouragement to miners hedging. I can understand that. I think as far as industry is concerned, they don't care too much about this because they're in there buying silver, basically, by stand for delivery. That's really their interest. But I think what we're likely to see is, rising yields will start, if you like, making everybody aware of currency risk. And I think, gold going up through 5,000, I think would probably be as good an indicator as any. I mean, the fact that gold has actually risen in recent months very, very strongly does tell us that gold is front-running a deteriorating situation for fiat currencies, led by the dollar. So further rises in the gold price, I think it sort of confirms it. And what this means is that the great problem in 26 and 27, which nobody really expects at the moment, is soaring inflation. Inflation prices will be rising very, very sharply because the purchasing power of the currencies is going down. And of course, this isn't in the lexicon of the FOMC in the States. I mean, you read their statements, they hardly ever refer to the quantity of money, the changes in the quantity of money, or indeed the faith in the dollar. That's hardly ever mentioned, but it's overowned by foreigners. And as these events, unfold, I think you'll find that there's going to be massive liquidation of, sort of cross-border investments.
In this in-depth market analysis, leading monetary analyst Alasdair Macleod explains why the silver market is entering a structurally dangerous phase, driven by tightening supply, surging industrial demand, and mounting stress within paper markets. A critical shift is now underway as China, the dominant global force in silver when mine output and refining are combined, has stopped suppressing prices and is actively tightening export licensing to prevent excessive silver from leaving the country. This policy shift comes just as demand for silver is accelerating at unprecedented levels. Industrial users, particularly in photovoltaics and advanced manufacturing, are aggressively locking in supply by standing for physical delivery in both London and on COMEX. COMEX deliveries alone have reached roughly 15,000 tons this year, representing an estimated 58% of global mine production, an extraordinary figure that highlights the growing physical strain on the market. Contrary to popular belief, this is not a speculative rally. Open interest remains below historical averages, indicating that price action is being driven by real, physical demand rather than leveraged traders. As a result, rising margin requirements are hitting bullion banks and swap dealers harder than speculators, intensifying pressure on short positions. At the same time, strength in gold is signaling deeper currency instability ahead. As purchasing power continues to erode, inflation risks heading into 2026 and 2027 may be severely underestimated, potentially triggering broad liquidation across cross-border investments. Now, let's get into the interview.
If you look at copper in particular, which is another must-have metal for the same reasons as silver, the price measured in gold is roughly 18% of where it should be in terms of long-term value. So that means that even priced in gold, copper is likely to increase by 4 or 5 times. So what does that do to the price of copper in dollars? Well, through the roof. And as the markets begin to understand this, the supply of copper is going to into markets is going to diminish. We've already got a battle royal between America and China over the Democratic Republic of Congo, and also in Zambia, which is the major copper producing center in Africa. So And China, I understand, is the largest refiner of copper. If China puts that on the restricted list, then I think it's going to be people will wake up. I tell you, they really will wake up. The increase in margin requirements on COMEX was hitting the big US banks, and consequently, the Fed had to step in with repos of around about 17 trillion. Sorry, 17 billion, not trillion, 17 billion. Now, actually, if you looked at the numbers, I mean, there's complete nonsense because it's not the banks who are short. They're actually long of silver derivatives. It's the non-US banks, the 17 non-US banks, which are short. And of course, they're long in London. So, I mean, and, the Fed, this was on Christmas Eve, the Fed producing, repo, intervening in the repo market. I mean, the reason they intervene in the repo market is basically to hold the rates within their target range. And we've got a year end. You've got all sorts of factors, which might mean that banks need overnight finance to ensure that their books are square. And it's not just silver, for goodness sake. It's, it could be everything. It could be interest rate swaps. I don't know, whatever, bond positions and so on. So, and also bond failures too. This is the other thing, fails to deliver. Apparently, they've risen quite significantly. So I think the point about increased margin requirements on futures.
In this market briefing, metals expert Alasdair Macleod breaks down copper's deep undervaluation and what it means for investors in global markets. Like silver, copper is both an essential industrial input and a monetary metal. When pricing gold, copper is trading at roughly 18% of its long-term value. That gap implies a potential 4 to 5-fold rise over time, driving sharply higher dollar-denominated prices as markets confront the reality of constrained supply. Macleod also points to rising geopolitical tensions weighing on copper availability, particularly between the United States and China, and across Africa's Democratic Republic of Congo and Zambia, where much of the world's copper is produced. With China dominating global refining, supply is further tightened, adding upward pressure on prices. As these strains build, the effects are likely to ripple across futures markets. The recent increase in COMEX margin requirements, impacting major U.S. banks, signals growing systemic risk across multiple asset classes, including silver, bonds, and interest rate swaps. Non-U.S. banks holding large short positions are under increasing stress, contributing to volatility and the risk of delivery failures. Taken together, these dynamics highlight the importance of vigilance and strategic positioning in physical metals and other essential commodities. If you found this breakdown helpful, like, share, and subscribe.